Let's first enter the transaction on an accrual system using accounts receivable and accounts payable as though we're imagining cash is going to be involved. Therefore, when we receive the money for the accounts receivable, pay the money for accounts payable, we'll use the checking account, and we will note that the transactions will net out within the checking account. Then we'll think about why we might not want to do that using the actual checking account, but basically just simply set up a clearing account for the barter transaction. So for example, let's imagine that we're going to have the accounts receivable. We're going to provide the landscaping services. They're going to provide us with something like supplies, let's say. So we can record it in the same first transaction for an invoice, basically increasing the accounts receivable when we invoice somebody. The other side going then to income. So there's going to be the first transaction, and then let's imagine that they actually provide us with the supplies. So when they provide us with the supplies, we have basically we can imagine that's going to be a bill payment form. So we could then say on the bill payment form, we're going to have an expense side of things of 100, and then the accounts payable side of things will be the 100. Now notice that these two amounts happen to be the same, but we can imagine that they're not exactly the same, so that we still have an outstanding balance between the barter transactions, right? So we can track the accounts receivable or the accounts payable. So then we can say, okay, we've basically received the payment now. So when we receive the payment, what I'm going to say, because we received it in a barter transaction, but we're just going to use the checking account as basically our clearing account to net this out. So we're going to say, all right, then cash is going to go up. Now, I'm going to imagine I didn't actually receive cash. I received a barter transaction, but I'm going to use the checking account as though I received cash. And then accounts receivable is going to go down because we received the payment in terms of the barter transaction, in terms of the supplies. So that goes back down to 0. That has been recorded. Let's make that yellow maybe. And then down here, we're going to say, also, we have paid off the accounts payable, right? We paid off the accounts payable because we provided the landscaping services. So that's going to be this transaction. Accounts payable goes back down, and then cash is going to go back down. So you can see cash goes back down to 0 here. And so we can basically record the barter transaction as though cash was impacted, because it will have no net impact on the cash. Now, we could make this a little bit easier to record if the two things happened at the same time, simply recording the expense and then to cash like we would with like an expense or check form. And then instead of going through accounts payable, we record just, and then when we go to the revenue side of things, we would record similar to a sales receipt, which would increase the cash and increase the income. But I'm going to use the full accrual system here because we might have a situation where we still want to track the outstanding accounts receivable or outstanding accounts payable that is still owed if the full barter didn't exchange equal value at any given point in time. All right, so now let's say, well, the reason this is still going to be a problem, though, is because I don't really want to post these two transactions here to the checking account, because that's going to muddy up my bank reconciliation a little bit, because I'm going to have to check those two things off when I reconcile. So I could do that, but it'll make it a little bit messy because I'll have to recognize those two so I can check them off. It would be easier if I set another account up, which I'm going to use it as a same kind of check, a type of cash account, so it functions the same, so I can still see it when I enter a payment form or an expense form or a receipt, right? But I'm not going to, it's always going to be cleared out to 0 because I'm going to use that as my bartering account, right? So it would look something like this, same kind of idea, it's just the same thing. We'd say, okay, if I'm going to invoice somebody, we did work, we're going to invoice them. So I'm going to say accounts receivable is going to go up because we did landscaping work for somebody. We expect them to pay us, but pay us with supplies or whatever the barter is that they give us. So, and then we're going to say when they give us the supplies, we're going to put that into an expense. Now, remember, they might not give us an expense. Maybe we're doing landscaping services and they're going to give us like meals or something personal. If it was personal, we could still do it, but then we wouldn't put it into the expense here. The other side would go into equity. It would be into draws, like some kind of equity account, right? So that would still be kind of possible for a barter. We give them services. They give us something not cash, but not business related, personal related, in which case what we received would go into draws. But we'll put it into the expense account here. So we're going to say expense goes up, and then accounts payable. So there's the accounts payable goes up, and now the two have netted out. We've paid each other because now we have an equal amount in accounts payable and accounts receivable from the same customer and vendor. So those two basically net each other out. I'm going to net them out with the receive payment form and bill form, but this time not to the actual checking account, but simply to the clearing account. So then we're just going to net these out and go boom, and we'll put this into the clearing account. So clearing account is going to go up by 100, and then the other side is going to go into the accounts receivable. It's going to go down by 100, and then this one is going to clear back out as well. So we're going to say this is going to go up to the accounts payable, or it's going to decrease the accounts payable, and the other side is going to go once again into the clearing. So we just imagine that cash is going to be involved, do it the same way, but let's not put it into the actual checking account, because this one will clear out to zero, and it will always basically, be negative at the end of the day, or be zero at the end of the transactions. Now, again, if these happened at the same point in time of equal value, you could just say, okay, I'm not going to go through accounts receivable, accounts payable. I'm just going to use basically a sales receipt form and an expense form. So we're going to say then if this was 100, negative 100, 100, and negative 100, we just say, all right, we'll just put this into the clearing account this way, and then income. And then the other side, we just put in at the same time, which would be an expense and the clearing account, Now notice you might say, hey, look, the impact on net income is nothing, because income went up and expenses went up. But again, the idea should be that we should have your gross income should still be recorded, and then record the related expense. And if there's any sales tax involved in the transaction, you would owe the sales tax, and so on and so forth. So even though it nets out to zero, we should be recording the revenue and the expense generally in that case. So let's actually